Welcome back to Smart Stock Sam, the channel where we cut through the noise and hand you the intelligence that actually moves your portfolio. I'm Sam, and before we dive in, make sure you hit that subscribe button right now, because what we're about to cover today is the kind of breakdown that most analysts charge huge sums, and you're getting it completely free. Here's the question nobody on Wall Street wants to answer honestly. What happens when a company is doing absolutely everything right, crushing earnings, printing cash, dominating its industry, and the stock still falls nearly 20%? That is not a glitch. That is not a mistake. That is the market sending you a warning shot. And the name on the target today is Palantir Technologies. Now, if you clicked on this video, you already know what's at stake. Two price levels, $130 and $145. Those are not arbitrary numbers on a chart. Those are the fault lines of this entire trade. One of them is a floor that could save the bulls. The other is a ceiling that is currently crushing anyone who bought the breakout. And by the time this video is done, you will know exactly which side of this trade you want to be on, why those two levels matter more than any earnings report, and the precise entry and exit scenarios for the week of May 26th through May 29th. We are going to walk through the fundamentals, the geopolitical risks, the insider behavior, the analyst divide, the technical breakdown, and the options market positioning, every layer of this story, before I hand you the exact trade setup. This is the Palantir valuation conflict, and it is one of the most fascinating battles playing out in the market right now. Let's get into it. So here is where we start. Forget the stock price for one moment. Forget the chart. Just look at the raw engine under the hood of this company and ask yourself, have you ever seen numbers like this from a company at this scale? Palantir's fundamental performance right now puts it in what analysts call the elite tier, the rare category reserved for companies like NVIDIA that seem to defy gravity on every single metric. We are talking about revenue growth running at 85% year over year. A profit margin that most Fortune 500 companies would trade their entire board for, a cash balance that could buy several mid-sized competitors outright. And yet, the stock is down nearly 20% since January 1st. Think about that for a second. The business is sprinting at a pace that Silicon Valley's best would envy, and the stock is bleeding out. Why? Because when you trade at a trailing price-to-earnings ratio of 140 times earnings, you don't just have to be great, you have to be perfect. Every single quarter, without exception. And the moment the market smells anything less than perfection, geopolitical friction, rising interest rate concerns, a legal dispute with a government client, that premium valuation gets questioned in a very painful way. That multiple compression is exactly what we are watching play out right now, and it sets the stage for everything we are about to unpack together. But before we get bearish, let me show you what the bulls are actually looking at, because ignoring these numbers would be intellectually dishonest. Palantir's first quarter results were not just good, they were historic. Total revenue came in at $1,633 million. That is an 85% jump from the same period 1 year ago. Now, revenue growth alone does not move the needle the way it once did. So here is the number that really made the bulls erupt. U.S. commercial revenue surged by 133% to $595 million. 133% in a single quarter, in one of the most uncertain macro environments in recent memory. This matters enormously because for years, the bear case against Palantir was simple and repeatable. They are a government contractor with a nice software wrapper, too dependent on defense contracts, not a real scalable commercial business. Well, that argument is getting increasingly difficult to sustain when your commercial division is growing at triple-digit rates and accelerating. They also posted a GAAP net income of $871 million, delivering a 53% profit margin. And here is the metric that truly separates real software businesses from pretenders: the Rule of 40. In our industry, a score of 40% is considered elite. It means your growth rate plus your profit margin equals 40 or better. Palantir just posted 145%. That number is almost unprecedented at this scale, and it tells you the underlying engine of this business is operating at an extraordinary level. Now, growth and profit are impressive, but in a volatile macro environment where the Federal Reserve can flip sentiment overnight, balance sheet strength matters just as much. Here is where Palantir's story gets genuinely compelling. The company is sitting on $8 billion in cash and short-term Treasury securities. $8 billion. And the single most important figure on that entire balance sheet? Zero. That is their long-term debt. $0 owed to any creditor, any bank, any bondholder. This is what I call a fortress balance sheet, the kind of financial position that makes a company structurally bulletproof regardless of what the Federal Reserve decides to do with interest rates next month or how dramatically the market decides to reprice risk next quarter. $8 billion gives Palantir options that most of their competitors can only dream about. They can acquire rivals at attractive prices during downturns. They can execute massive share buyback programs. They can outinvest everyone in the AI infrastructure space without ever touching a credit line. From a pure financial health standpoint, this company is genuinely in a class of its own. But, and I need you to really internalize this, balance sheets don't trade. Stock prices do. And right now, something is applying pressure to this stock from multiple directions simultaneously. Let me show you exactly what that looks like on the ground. Europe is becoming what I can only describe as a localized geopolitical nightmare for Palantir, and the damage is happening on three separate fronts at the same time. In the United Kingdom, London Mayor Sadiq Khan recently blocked a £50 million contract with the Metropolitan Police, citing procurement concerns and, this is the word that should make every Palantir investor pause, values. Palantir's UK leadership is pushing back hard, arguing that blocking this contract prioritizes politics over public safety. But here is the uncomfortable reality. When a government official blocks your contract on values grounds in a major democratic capital, it sends a message to every other public institution in that country watching from the sidelines. Meanwhile, Germany's domestic intelligence agency went through a competitive evaluation and chose a European rival called ChapsVision over Palantir, specifically because of digital sovereignty concerns. They wanted a European solution keeping European data in European hands. And in Switzerland, regulators are now formally labeling Palantir a potential security risk regarding data control and cross-border data transfer. 3 separate countries, 3 separate rejection signals, all within the same quarter. Now ask yourself honestly, could Palantir lose meaningful European government business across the next several years? The probability might seem manageable. But in investing, the direction of travel matters just as much as the destination. And right now, the direction in Europe is not friendly toward American AI infrastructure companies. The trouble is not just overseas, though. The Defense Intelligence Agency, the DIA, is actively attempting to build its own in-house analytics platform called the Mars Project, essentially trying to replace Palantir using internal government resources. Palantir has responded with a formal legal protest, arguing the government is wasting taxpayer money attempting to recreate something dramatically inferior to what Palantir already provides commercially. And truthfully, they have a strong argument. But here is the more important question for investors. What does it signal for the bull case if Palantir starts losing the very government agencies that defined their reputation in the first place? The outcome of that DIA legal dispute will serve as a real-time stress test for the government revenue floor. And this is precisely why that 133% U.S. commercial growth is not just impressive. At this stage, it may be existentially necessary. Now let us follow the money more closely, because this is where things get genuinely revealing. Institutional investors, the Vanguards and BlackRocks of the world, own approximately 66% of Palantir. Nearly 2/3 of the entire float is anchored by the most patient, most disciplined capital allocators on the planet. That is a meaningful, stabilizing force and explains why this stock has not fallen completely apart despite the headwinds. But on May 20th, something happened that every serious Palantir watcher needs to know about. Insiders, specifically the Chief Revenue Officer and the Chief Financial Officer, sold over $5 million worth of stock in a single session. Executives sell shares for many reasons: tax planning, portfolio diversification, personal liquidity. We cannot assign a single motivation with certainty. But when the people who possess the deepest, most intimate knowledge of this company's near-term pipeline decide to lighten their positions at today's prices, that is a data point you cannot responsibly ignore. It strongly suggests that leadership does not view the current price as a significant bargain. The divide among Wall Street analysts right now is as pronounced as I have seen in years. On the cautious side, Cantor Fitzgerald holds a price target of $138. They are not questioning the quality of the business. They simply argue the stock is priced too richly to justify new positions at current levels. On the aggressive bull side, Rosenblatt and Citigroup are both holding strong buy ratings with targets of $225, citing those extraordinary earnings numbers as justification for sustained premium pricing. The Analyst consensus average sits at $189.38, but with individual price targets ranging from as low as $90 all the way up to $230, that average is essentially meaningless. When smart, well-resourced professionals disagree by $140 on where a stock should trade, what you actually have is a market in genuine price discovery mode. And when nobody agrees on fair value, the result is exactly what we are watching: sustained volatility with no clear resolution in sight. The technical picture is unambiguous right now, and the message it is sending is not one the bulls want to hear. The daily technical summary for Palantir is flashing a strong sell signal across multiple indicators simultaneously. The stock is trading below all three of its major moving averages: the 20-day, the 50-day, and the critically important 200-day. When a stock loses its 200-day exponential moving average, currently sitting at $149, the long-term structural uptrend is officially broken. That is not a minor technical concern. That is a definitive change in trend classification. The RSI is sitting at 48, which places us in neutral to bearish territory. And here is the detail that really complicates the recovery picture. Short interest stands at only 2.7% of the float. Why is that bad news for bulls? Because it means there is almost no fuel available for a short squeeze rescue. There are too few short sellers who could panic buy and artificially accelerate a recovery. This downside move is being driven by real sellers with real shares making deliberate decisions, a far more serious and sustained dynamic than a speculative positioning unwind. The chart pattern that has formed over the past several months will be immediately recognizable to any experienced technical trader. We are looking at a textbook head and shoulders reversal pattern, one of the most reliable and most watched bearish reversal signals in all of technical analysis. Three distinct peaks. The middle one is the highest, flanked by two lower shoulders on either side. The critical neckline of this pattern sits precisely at $145, a level that served as firm support for months and has now definitively flipped into severe resistance. Until Palantir can close convincingly above $145 on above-average volume, every attempted rally becomes a potential shorting opportunity for the professionals who are actively watching this structure. The options market, however, is telling a slightly more nuanced short-term story, and this is why I always look at multiple data sources before forming a view. We have massive call walls building at $140 and $145. These are levels where market makers are structurally positioned to keep the stock pinned and will fight hard to defend. But here is the counterintuitive part. The put-to-call volume ratio on Palantir currently sits at 0.59. A number below 1 means options traders are actually leaning slightly bullish in the very near term, positioning for a bounce even while the longer-term chart structure remains damaged. On the downside, we have strong put walls at $130 and $125 that should act as a meaningful cushion if selling pressure intensifies. Together, this creates a clearly defined, genuinely tradable channel for the week ahead. To sustain a 140 times earnings multiple over any meaningful time horizon, Palantir must execute on 3 specific pillars without wavering. Pillar 1. U.S. commercial growth must stay above 100%. That is the only engine running fast enough to organically grow into such a demanding valuation. The moment that growth rate decelerates into the double digits, the valuation math collapses rapidly. Pillar 2. Revenue per employee. Management has stated a bold goal of achieving 10 times their current revenue with only 3,600 employees. Deliver on that, and Palantir proves itself a genuinely elite high-margin software platform. Fall short, and the critics will rightly call them an expensive consulting operation with extraordinary marketing. Pillar 3. Government contract retention. The DIA legal dispute is the definitive litmus test for the foundational revenue layer. Lose that battle, and a revenue floor that institutional investors have relied upon for years suddenly looks far less certain. Here is your precise tactical roadmap for the week of May 26th through May 29th. The high probability trading range I am mapping for this period is $134 to $142. Your primary resistance level is the 200-hour exponential moving average sitting at $138.80. If the bulls cannot reclaim that level convincingly, the path of least resistance remains lower. Above that, the $140 call wall becomes the next real target. On the downside, a classic pivot support sits at $134.30, with the ultimate put wall floor falling between $128.50 and $130 even. Now for the execution scenarios, because having levels without a plan is not a strategy. Scenario A is the conservative entry. You wait for a decisive daily close above $138.80 on meaningfully above average volume. That single confirmation candle changes the near-term thesis and opens the door for a move toward $145. Scenario B is the aggressive bounce play. If price drops into the $134 zone and you observe volume drying up, sellers exhausting their pressure, you begin accumulating there with a clear target of the $140 call wall above. Scenario C is your invalidation and exit signal. If we get a clean close below $132, the bounce setup is officially dead. That break opens the door to a much deeper move toward $126, a level now appearing in prediction market models with increasing frequency. Protect your capital before protecting your thesis. The final verdict on Palantir. This is a high-variance asset currently priced for absolute perfection in a market environment that is rapidly losing its tolerance for perfection-priced assets. In the short term, May 26th through May 29th, expect range-bound action between $130 and $140 with a mild but persistent bearish bias. The technical damage is real and will require significant, sustained buying volume to repair meaningfully. On the longer macro horizon, Palantir remains arguably the most differentiated player in AI infrastructure globally. Their AIP ontology platform has a genuine shot at becoming the operating system enterprises use to run their most critical decisions, a category-defining position if they can capture it. The biggest structural threat, long-term, is not the valuation itself, but the hyperscaler competition gathering momentum from Microsoft, Google, and Amazon, companies with deeper enterprise relationships, more extensive distribution, and near unlimited capital to invest in competitive solutions. Palantir has the technology. They have the fortress balance sheet. Now they have to prove they can win the politics, survive the legal battles, and sustain extraordinary commercial growth all at the same time. Before we wrap up, I want to be completely clear. Nothing in this video constitutes financial advice. Every piece of analysis you just heard is for educational and informational purposes only. Markets are unpredictable, all investment decisions carry risk, and past performance is never a guarantee of future results. Always conduct your own research and consult a licensed financial advisor before making any investment decisions with your own capital. Now, here is the question I want you to answer in the comments below, and I am genuinely curious about your perspective on this. If Palantir wins the DIA legal protest and simultaneously sustains above 100% U.S. commercial growth for 2 more consecutive quarters, does that combination finally justify paying a 140 times earnings multiple? Or does valuation discipline eventually win regardless of how extraordinary the underlying fundamentals are? Drop your answer below. This is one of the most important valuation debates happening in markets right now, and I read every single comment on this channel. If this breakdown gave you real clarity, do me one favor right now. Hit that like button. It takes 1 second, and it helps more investors find this content when they need it most. If you are not subscribed yet, join the Smart Stock Sam community today and ring that notification bell so you never miss a breakdown like this one. And if this kind of deep dive analysis genuinely adds value to your investing process, please consider supporting the channel directly through YouTube's Super Thanks feature. Every contribution keeps the research going, the tools running, and the breakdowns coming week after week. This is Smart Stock Sam. I will see you in the next one.